Thank you, Bruce, for the kind introduction, and all of you for making the effort to come here. The paper is joint work with Li Zhang from Rutgers, and it was fermented by Bruce, who came over and suggested that he has a unique data set that we should explore, and we took a look at it, and it was fantastic. We went ahead and wrote a paper. It's forthcoming in the Journal of Investing. So data acknowledgements, we want to thank the Wall Street Horizon for providing us the data, and Kuber Systems, which provided us the point-in-time CompuStat data that we use in the study. What are we looking at? So the question is very, very simple. It's sort of the low-hanging fruit to be used in the Wall Street Horizon data, and that is the timing of earnings important for investors? And the idea is firms can either jump ahead and announce that they would release their earnings early or earlier than anticipated. And that usually is a good signal, because a firm would go in and release earnings early because it wants to take advantage of good news, typically. Likewise, if a firm delays its earnings announcement, that's usually bad news. And the reason is the firm is reluctant to provide the information and is hoping that maybe there would be some positive event that they can use in order to offset the bad news, or is looking to other firms in the industry to announce even worse news, so they would not look as bad as before. And what we find is that this is indeed the case. Firms that have good news tend to announce earlier than anticipated. Firms that have bad news tend to announce later than anticipated. And surprise, surprise, if you come up with a trading strategy based upon that, you could get an abnormal return. We also look at firms that delay what they said would be the earnings release date earlier. So a firm says, we are going to release earnings on April the 30th, and on April the 15th, they come and say, uh-oh, they don't say why, but we are going to delay it to May the 10th. That's bad news, and it's very bad news because they committed to an earlier date and didn't make it. This is really bad news, and we find that to be the case. Okay, I'll skip the motivation since I did that anyway, and the contributions, and let's skip immediately to the data sources and sample selection. The sample is based on the Wall Street Horizon data, and the data is from 2006 to 2013. With everything that, every data set that we take, we of course check the quality of the data. And I must say that what we did when we checked the data, we first of all found the announcement dates to be correct. We found slightly more issues in the beginning of the data period, 2006, 2007, but later on the data was impeccable. Now, the way we are going to talk about it is there are two kinds of events that we'll address. What we call the DTV events. DTV would mean that there was a change from tentative to verified. What is tentative? Tentative would mean that we rely on the Wall Street Horizon people to forecast the date on which earnings are going to be released. So typically in academia, when people did this type of studies, what they did was to look at what happened in the past, and if they found out that a firm announces typically 27 days after the quarter ended, they would use 27 days after the fiscal quarter end as the expected date for an earnings announcement. The Wall Street Horizon does substantially better than that. Of course, they would use the prior periods as a guideline, but they would also have contacts with the companies and would know some additional details. For example, the company may always announce earnings on the third Tuesday after the quarter ended. And if that is the policy of the company, they would have a better forecasted day for earnings. So tentative would mean that this is the forecast date by the Wall Street Horizon. Verified would mean that the company told us in a public announcement or on their website, or when it was contacted by the Wall Street Horizon analyst, it told, this is the date on which we are going to release earnings. So we had a forecasted date by the Wall Street Horizon. We had a verified date, which is verified by either the company's own announcement, public announcement, or on their website, or when they were contacted by the analyst. And what we do is we look at the cases where the date that was forecasted is at least 4 days apart from the date that was verified. Why 4 days? Because we want it to be meaningful. We wanted either the delay or the advance to be meaningful. So we wanted to focus on extreme or more extreme changes. And what we do is we use the delay as a negative signal. We use the advance as a positive signal for trading. DVV events are the worst cases. That is where a company told you, we are going to announce on the April 30th, and then tells you, no, 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 by the way, we made an error. We are going to announce on May the 15th. That's a DVV event. All the stock return information is from CRISP, which is the database that academics use. It's usually free of errors, or more free of errors than other databases. And we use the company's financial information from CompuStat. The abnormal returns that we use in the paper are all buy and hold returns, which are the buy and hold returns on a particular company, minus the value-weighted average returns on stocks with similar size, book to market, and momentum. So what we do is we try to control for the very well-known sources of risk, which are captured in Fama and French type factors. Earnings surprises are the usual seasonal random walk model, and that is earnings per share minus earnings per share 4 quarters ago, with a little bit of adjustment for average growth or average decline in the earnings over the past, divided by the standard deviation. So what do we predict? We predict that DTV events, if the company advances the date, the market reactions should be positive. If it delays, it should be negative. DVV events are always negative, and we attempt to examine that. So first graph shows what happens to subsequent earnings when a firm advances its disclosure day. And as you can see, the blue bar shows you the percentage of positive earnings surprises. The red bar shows you the percentage of negative earnings surprises. And on the left, what we see is firms that advance their disclosure day. So we see that there is slightly more positive news announced for firms that came up and said they would release their earnings earlier. What about firms that delay their earnings announcement. There the pattern is much clearer. About 44% of those have positive earnings surprises, and 55% have negative earnings surprises, which is more of a clear case that firms that delay tend to be associated with more negative earnings surprises. More interesting is to look at returns. And again, the blue bar on the extreme left shows us that 52% of the cases, firms that announce that earnings would be released earlier have positive returns, and 47% negative returns. And likewise for the delayed firms that delay their forecast, we have 47 and 52%. So the returns are in the direction that you would expect. What we do next is to look at what happens to a long window from 2 days after the event until 90 days afterwards. So 90 days after the subsequent earnings announcement. So we are talking about a longer term holding period, just in case an investor wanted to expropriate not only what would happen in the next earnings announcement, but some of the post-earnings announcement drift. And the results are very similar to what we observed earlier. What we did was to examine 3 windows here, and I know the table is a little difficult to see, but again, for the earlier events, and here what I want to do is just point your attention that during the sample period, we found about 4,700 observations where a firm advanced its disclosure day by more than 4 days. We found 13,000 where they delayed. So the majority of cases are delays rather than advances. When we look at the advances, we see that there is an immediate positive market reaction, not very strong, only about 20 basis points. If you hold the stock from 2 days after the announcement until 1 day after the earnings announcement, remember we surmised that the earnings announcement would be when the news would be discovered to be either positive or negative. So for the earlier sample, we find that this return, abnormal return, is 115 basis points, which is significant. If you hold it for 90 days after the earnings announcement to capture also the post-earnings announcement drift, then it goes up to 216 basis points. What happens if, for firms that are delayed, market reaction is negative, but not significantly different from 0, only 5 basis points. If you hold it until the next earnings announcement, 44 basis points negative. If you hold it for 90 days after the earnings announcement, 78 basis points. So the message is the markets behave the way we would think they would behave. And mind you, this is information that is available to you once you get the data from the Wall Street horizon. Because you immediately know what was the forecast, what was the verified time period that the company had, and you know whether it's changed by more than 4 days the way we did it. In terms of characteristics, we couldn't find much different between firms that advanced than those that delayed. The only thing that we found was a little bit of a size difference. Firms that advanced it were smaller firms, and that again makes sense because this type of firms want to stand out and have a better incentive to rush to the market, so more people would know about them and know the good news that they're going to provide. We do some testing, which is standard academic testing, and put a dummy variable, which is 1 for early, 0 for delayed, and you could see that it's positive and significant after we hold the other type of suspects for that could affect abnormal returns like size and book to market. We also form a monthly calendar time portfolio. So here what we do is we stand at month end, we look back to see what firms either delayed their forecast, delayed their press release of earnings or advanced it by more than 4 days, and make an investment in those firms, hold it for 1 month. At the end of the month, repeat the exercise with new firms or with firms that are still within the 45 days. And the long side of this portfolio earns 89 basis points. The short side earns 29 basis points. Here what we did was to reverse the position on the short, so it's an additional 29%. So a hedge portfolio earns 119 basis points. Just graphically to see what it looks like, what we have here is the returns on the long side of the portfolio, and you could see that in most months, 51 out of 82 months, the returns are positive. And what is nice about this graph is you see that most of the positive returns happen to be later on in the period that we studied, not at the beginning, which is comforting. The market has not caught up with it. If we look at the hedge portfolio, it performs even better. 60 months out of 82 have positive returns. And again, the pattern is clear that on the right-hand side, later on during the period, it's still working well. I mentioned the DVV events. Those are cases where a company changed from April 30th to May 15th, and you could see it's negative all around and statistically significant as a trading strategy as well. However, to be modest about it, there are only 588 cases in the Wall Street Horizon database. So we don't have that many such instances, but those may be quite beneficial as well. So to conclude, what we find is that just the mere announcement that we are going to announce a little earlier than forecasted is good news. If we're going to release earnings a little later than anticipated, that's bad news. You could take a trading strategy based upon this information, and that is beneficial to you. And we think the findings are relevant not only for investors, but also analysts who examine corporations and have to come up with forecasts. That this is additional information about the quality of earnings and the direction of earnings that is to be expected. And also for option traders, which have to value the options. Thank you.